Hey everyone, welcome back to another Bitcoin and cryptocurrency video. In today's video we will be discussing the most recent up-to-date unemployment rate data that came in this morning. If you like this type of content, make sure you hit that like button, make sure you hit that subscribe button, and if you are a fan of cryptocurrency, I have a cryptocurrency shop where you can shop cryptocurrency products. I'll leave a link in the description down below so you can get a nice discount off your next purchase. So without further ado, let's begin, and I just want to quickly apologize. I've woken up with some sort of a sore throat this morning, hence why my voice might sound a little different. I kind of like it, but at the same time I don't like having a sore throat. I think is one of the most annoying things you could have on this planet. But yeah, let's begin with the video. So I tweeted earlier, Bitcoin reacting to the new positive unemployment rate data coming in. Short-term relief for Bitcoin and the rest of crypto. So in this video, we're going to discuss what the most recent data suggests, what it means. We're going to analyze why that is a short-term relief for Bitcoin and crypto. And then we're just going to analyze what the unemployment rate means in general and why that can be bullish if it's low and why that can be bearish if it's high. So just by taking a look at Bitcoin's data, this is the hourly chart. You can see that the news broke out this morning, and since this morning Bitcoin has been in a nice sort of uptrend, as you will. It's had a nice little pump since this morning because the data was relatively bullish. So last month's data came in and the unemployment rate was at 3.9%, a 0.2% increase from the previous month. So the unemployment rate increased 0.2, so it was seen as kind of spooky because I believe that 4% level is a level that we need to keep an eye on before things start to get a bit sticky. On the other hand, data came in this morning and data has come in at 3.8%, a negative 0.1% decrease from last month's data. So why is that bullish for Bitcoin? Well, it suggests that when the unemployment rate is low, it suggests that we can be in a risk-on environment. And it blew expectations, which is one thing, but the other thing is that it avoided that 4%, which is what I was talking about earlier. I think if the unemployment rate hits 4%, or prints a figure that's above 4%, that could spell bad news for the economy and for risk on assets like Bitcoin and the stock market. The reason why a high unemployment rate isn't good is because when we compare high unemployment rates in prior history, you can see that, we've had high unemployment rate in the 80s, which concluded in a recession. We had a high unemployment rate in the late 80s, early 90s, which concluded from a recession. We had high unemployment rate in the early 2000s, which concluded from the tech bubble recession. We then had high unemployment rates in the late 2000s, which stemmed from the recession of the global financial crisis. And then we had a massive wick to the top of unemployment in the early 20s due to the pandemic short-term recession. So a high interest rate, a high unemployment rate is not good for the economy and risk on assets like stocks and crypto. What is kind of negative at the moment is that the unemployment rate, even though you can't do technical analysis, the unemployment rate is forming higher highs and higher lows. You can see from March, April 2023, where the unemployment rate was 3.4%, the unemployment rate is now starting to rise. So what does that mean? Why is it rising? Well, the unemployment rate is kind of confluent with interest rates. When the Fed is printing higher interest rates and rates are higher for longer, we are in a constricting environment of quantitative tightening, which is when the Fed's reducing the size of their balance sheet, they're putting pressure on financial companies. Money is more expensive to borrow. Money is more expensive to pay back. It's just a tight financial monetary policy, which just isn't good for the economy in the short term. So a high unemployment rate spells danger, it spells trouble, but it increasing does make sense because and it goes to suggest that the economy is now starting to feel the effects of a tight monetary policy. If we overlay this with interest rates, and this goes hand in hand with interest rates. Oh no, this is the inflation, I believe. Where's the interest rates? Right here. So if we overlay this with interest rates, you can see that the unemployment rate always tends to increase massively at the back end of rate cuts. Yeah, you can see that in prior history, when we started to get rate cuts, unemployment rate went up. When we started to get rate cuts, unemployment rate went up. As we started to get rate cuts, unemployment rate went up. As we got rate cuts, unemployment rate went up. And maybe as soon as we start to get rate cuts, which is suspected to happen later on this year, then that could spell trouble for the unemployment rate, and that could start to stem up like multiple times in prior history. But we haven't come to that moment of rate cuts yet. So as we are in this constricting monetary policy, it is a lagging indicator, because by the time that interest rates hits this moment right here, the reason why interest rates increase in the first place is to put a stop to inflation, because there's so much liquidity being printed within the economy. So the Fed essentially has to raise interest rates to combat inflation. But by the time we get to this point up here, when interest rates are already high, there's just still so much liquidity within the economy that the businesses and the companies are still functioning on this excess liquidity. It is only until interest rates are higher for longer, for some time, and even to the point where, let's say, even the Fed does cut rates from 5.5 to 5.25 or 5 or 4.5, it is still high. Interest rates are still high. So because it is a lagging indicator, companies and businesses don't feel the effects of rate hikes until later on in the business cycle. So the reason why they feel it late, again, because there's so much liquidity, but by the time you do get to rate cuts, that is when the companies and businesses feel the effects of rate hikes. And when they do feel the effects of rate hikes, that is when they lay off staff, because they cannot operate on this much liquidity no more, because there's not much liquidity in the system left, because the Fed drained it all from higher for longer interest rates, which is why when the Fed does cut rates, that is when the unemployment rate starts to spike. So with that being said, this is why I mentioned that 4% earlier, because if the unemployment rate prints a percentage above 4%, that will put the Fed in a sticky situation where they have to believe or where they have to assume that they need to cut rates soon. And cutting rates soon, again, spells trouble for the economy, because when they start to cut rates, it means that something has broken within the economy and they need to act fast. So when they essentially cut rates, they cut rates really quick, and at the same time, because of all the quantitative tightening, all the liquidity has been drained out, the unemployment rate shoots up. Why does this spell trouble for the economy? Well, let's just quickly compare this. And I just want to quickly note that since Bitcoin's existence, Bitcoin was essentially created this moment right here at the top of the unemployment rate back in the global financial crisis crash, recession, as you will. Bitcoin has relatively known an economy that has had an unemployment rate decrease for a decade. The only one time that Bitcoin experienced the unemployment rate spiking was obviously during the pandemic. And what happened during the pandemic? Bitcoin crashed over 50%. So it's kind of interesting to see now, because the unemployment rate bottomed at 3.4% back in, I want to say, January of 2023. And we all know that Bitcoin's been on an uptrend since January 2023. So there is some sort of negative correlation going on right now, but I'd assume when the unemployment rate starts to spike, that will spell bad news for Bitcoin. This is why we like to compare the unemployment rate with the S&P 500, because we don't have many data points for Bitcoin. Bitcoin didn't exist back in the 80s, the 70s, the 90s, so we cannot compare Bitcoin to these prior cycles of high unemployment rate. And because the S&P 500 is correlated with Bitcoin, as it is a risk on asset just like Bitcoin, it is interesting to compare it to the S&P 500 and see what happened when the unemployment rate was spiking. So, just at first glance, I mean, if we just go to the dot-com bubble crash, you can see that the S&P 500 peaked when the unemployment rate was going up. Yeah, because the unemployment rate bottomed in March of 2000, this moment right here. Yet the S&P 500 didn't peak until August of that year, which was right here. When the S&P 500 peaked, the unemployment rate was far off its lows. It was only when the unemployment rate spiked heavily that is when the S&P 500 crashed. Again, if we go again and we take a look at the global financial crisis, the unemployment rate bottomed around 2006, beginning of 2007, this moment right here. But it peaked around November of that year, whilst the unemployment rate was going up. It was not only until the unemployment rate started to go crazy where the S&P 500 experienced a massive crash. Just like in the pandemic. The thing with the pandemic is that it was so short. It was known as a black swan because it happened so quickly, and when the markets crashed, the Fed printed $6 trillion. I made a video on this the other day discussing inflation and discussing what the money supply is. We cannot essentially use this data because it happened so quickly. The Fed didn't let the business cycle play out like how it needed to. They essentially sort of kicked the can down the road, which is why we're in this moment right now. So you can see that the unemployment rate bottomed out. The S&P 500 put in new highs a few months later, but it was not only until the unemployment rate spiked, which is what caused that 50% crash. So what can we infer from this? We can infer that the bottom of the unemployment rate doesn't mean that the S&P 500 will put in a high. It is normally the S&P 500 or risk on assets will put in a high whilst the unemployment rate is going up. And then once the unemployment rate starts to shoot up, that is when the markets crash. Not at this point in time right now, which is why I'm saying when we do break that 4%, I do believe from 4% onwards, that is when the unemployment rate will start to rise heavily. And that is when the S&P 500 will have its crash. But for now, as rates are still higher for longer, the market can get away with climbing higher, climbing the wall of worry. It is only up until the unemployment rate puts in a percentage above 4%, which is where the Fed would then likely cut rates. But by then, it's too late. The liquidity has just been drained from the system. That is when layoffs will happen. And once that occurs, that is when the markets will crash. So the markets will peak after the bottom, and it's sort of kind of playing out right now because the unemployment rate bottomed in Jan of 2023. The S&P 500 is putting in new highs in March of 2024, April 2024. So a year later, the unemployment rate has been rising ever since. So do you see that correlation in past history? We can assume the same for Bitcoin, where Bitcoin has put in new highs whilst the unemployment rate has been rising. But once that unemployment rate shoots up, that is when the markets will crash. So that is it from me today, guys. I hope you all enjoyed the video. If you did, smash that thumbs up, smash that like button. And as always, it's been your boy, J1 General. Thank you and goodbye.